Hello everybody, welcome to Clef Investments. Today let's talk about when the inverted yield curve happens. How do you pick the box expiration when you want to borrow money? So in this channel, we have many videos to talk about how to use short box spread to borrow money. And when you do that, you use your stock as collateral, and box allow you to borrow money at a very low interest rate, which is only slightly higher than US Treasury bond. And also, all interests of the box are capital loss, which can further reduce your capital gain tax. So it's a good way to borrow money. But when you borrow money, you have to decide what term to borrow. You borrow every 3 months or every 6 months, 1 year, and so on. And today is July 18th, 2025. If you check the treasury rate of today, you can find the interest rate is not euro. And you can see in the table on the right, the shorter the term, the higher the yield, and the longer the term, the lower the yield. So this is not common because usually when you borrow money for a longer term, there's a longer risk. You are giving up your money for a longer time, and you should get a higher interest rate. But why the yield curve is inverted? Why you pay higher interest rate when you borrow money for shorter term? The reason behind this is the market believes that the interest rate will drop in the short term. Basically, after a few months, if you reborrow, you can borrow at a lower interest rate so that it's still worthwhile to borrow at a higher interest rate now and wait for the interest rate to drop. Okay, so we need to decide which period to pick when we borrow money using box. And there are some general principles for picking the expiration date. If you borrow using a shorter term, it's more time consuming because whenever it expires, you need to renew the box. This also involves more commission because each time when you place options trade, you pay a few dollars of commission. It's not big if you are borrowing a lot of money. And then if you pick a longer period, the options are slightly less liquid, which means you give up more on the slippage. And also, as we talked last week, you have more prepaid interest if you borrow for a longer term. So these are some of the generic trade-offs of picking the expiration date. When the inverted yield curve happens, how do we pick? So our intuition may tell us that, well, if we borrow longer, the interest rate is lower, then why not pick the one with the lower interest, like I pick 1 year, 2 year, 3 years? Okay, let's look at a few examples. So in the history, the inverted yield curve happened a few times. From the mid 2000, it happened. So basically, the 6 months, 1 year, and 2 year interest rate is inverted from 6.42 drop to 6.3 as you increase the term. And then if you borrow at 2 years, you borrow at 6.3%. But if you borrow at 6 months, then after 6 months, you reborrow, you find the interest rate drops by a lot. It dropped down to 4.83. And after another 6 months, it drops further and it's 3.47%. And after another 6 months, it's only 1.9%. So you borrow 4 times and renew every 6 months, you're gonna pay much less interest compared to locking in the 6.3% of the high interest rate at the beginning. Then the next time inverted yield curve happens is around 2006. The 6 months interest rate is 4.59, while the 2 year is 4.54. So there's a slight difference. So the market predicts the interest rate gonna drop. But after 6 months, it slightly increased and stayed flat. And finally, it starts dropping. And in 2008, it dropped down to 2% and stayed there for some time. So if you borrow short term, you're gonna pay slightly more interest for some time. And finally, if you continue to borrow short term and renew, you're gonna pay less interest compared to you lock in a longer term. Okay, so this is around the 2008 real estate crash. And then this one is before pandemic. So in 2019, March, the 6-month rate is 2.5% and slightly higher than 2-year rate, 2.47. And if you borrow and 6 months and renew, you find the interest rate drops very quickly down to close to zero. It's 0.05 by 2021. And if you lock in a 2.47 interest rate, you would pay a lot more interest. So the general trend is, although you need to pay higher interest for the short term, it's commonly a good practice to pay the higher interest to borrow for a shorter term. And then you continue to reborrow to renew the box again and again. So in summary, when there is inverted yield curve, the interest rate may be more likely to drop than increase. So picking the shorter term, such as 6 months, is better in most cases compared to picking a longer term like 2 years. And if you don't like the trouble of renewing your box all the time, you can pick an intermediate term like 9 months or 1 year. And if you don't mind doing the renew more often, you can even pick shorter term, shorter than 6 months. But in general, picking shorter term and renew again and again would let you pay less interest in the long term. Okay, that's all for today. Thank you.